Hey, Amy Rankus with Proper Rate. Wanted to dive real quick into what's being promoted as the Biden mortgage plan, or as the media has spun it, the tax on buyers with higher credit scores. To dispel a great deal of the misinformation that is out there, I'm not going to try and argue the pros and cons of what has been recently implemented. I'm here simply to say this. If you have a higher credit score, you are not receiving a higher interest rate than someone with a lower credit score. We've been trying to balance or even the playing field. That's what Fannie Mae and Freddie Mac are trying to do to try and make homeownership more affordable for more home buyers. But ultimately, if you're doing a good job with your credit, you are still going to get the superior interest rate. So if you heard nothing else from me, that's important. Now, some of these changes, we don't exactly love all of them, but change comes sometimes with a little bit of pain. There was a victory this week in that they also wanted to make a change about debt to income and really hit or increase your rate if your debt to income was higher. Not ideal in this market, and I can explain a whole bunch of reasons why sometimes someone is going to have a higher debt to income ratio. But the takeaway is this. The Federal Home Finance Agency, who's responsible for requiring and implementing these changes, listened to industry leaders and decided to rescind or to not implement that particular price adjustment. So that's some good news. Hopefully we can make some more progress and continue to improve the rates and the situation for our buyers. If you have any questions about this or you want to talk pros and cons, there's a lot that I could share behind the scenes. But for now, I hope that's good enough. And if not, hit me up and we'll chat.